So, good evening to one and all. My name is Rohit Singh, and I'm a financial advisor at Global Financial Consultants. I welcome you all on behalf of GFC, and I hope you get a lot from tonight. This webinar will not be very long. We have speaker Deepak, as you can see him on the video. He'll be speaking later on power of systematic investment plan. But before that, I will just give a quick introduction about our company, GFC, since we have a lot of new attendees today. So Global Financial Consultants is a financial advisory company here in Singapore. It was initially established in Sydney, Australia in 1997 by Ian McMahon and Bruce Barron. Then they relocated to Singapore in year 2007. And since then, we have been helping our client with financial planning, be it any savings or investments, which is tax-effective investments, or any future financial planning like retirement planning or kids' education fee planning, or pension transfers, CPF investments, SRS, as well as how you can minimize your US assets, taxes on state tax on US assets. So that's an overview of GFC. One plus point about GFC over other companies here in Singapore is that we are not tied with any particular product provider. So that gives us the flexibility to choose a right product for our clients based on their objectives and financial goals and time frame from a range of products. As GFC has recently been nominated as one of the top 10 financial advisory companies in Singapore by Singapore Finest. So that was about GFC. I will now move to our one and only speaker, Deepak Singh. So he's the director of Global Financial Consultants. He has been with GFC for nearly 8 years and has established himself as one of our top performing financial consultants. He specializes in financial planning and insurance protection for individuals and groups, as well as advising on CPF investments. Deepak currently has an asset under management of approximately Singapore dollar 85 million. Just to let you know, if you have any queries or any questions, feel free to drop us in the chatter box that will be on, and we will answer as many questions as possible tonight after Deepak has done his presentation. So over to you, Deepak.
Thank you, Rohit. Thank you very much. And good evening to everyone. I hope everybody's having a great time. It's a great week, Wednesday, and the idea is to people who already know about the topics today, which we're investing in, but I did to educate the people and understand where the investments are and how can we help or how they can help in this time when the market's up on the other side. So we chose a topic. We're doing this on a monthly basis. And the topic for this month was systematic investment plan. The individual who have been investing from, just to say, like, can you hear me properly, everybody?
Yes, you are loud and clear. You are loud and clear.
Thanks, Roy. So systematic investment plan, I think is something is not unknown to at least for the Indian expats, but I just was wondering, and I was just thinking, and we having a chat last month with my team that a lot of people are still not aware that how do they plan the investment. So I thought like we'll take this topic and we'll try to go through and what we can offer to our clients and the prospects and how can we plan in the perspective. So to start with, what is a systematic investment plan? And when I say what a systematic investment plan is something very simple, is an investment mode which you can invest into mutual funds. It cannot be only mutual funds. It can be mutual funds. It can be ETFs. It can be equities. It can be bonds. What I meant about is like it's more about investing into a disciplined and systematic basis. As the term indicates, is a systematic method of investing fixed amount of your money periodically. This can be monthly, quarterly, semi-annual. Now, when I say different mode, I prefer my clients to do on a monthly basis. So when you invest steadily in a manner, it becomes easier to meet your financial goals. And financial goals can cater your personal objective. So how does this work? When you invest to a SIP, which is systematic investment plan, you invest a fixed sum of money in a given period. So individual need to understand how much they can allocate their funds from their savings for a particular tenure. Over the course of the given period, you have invested the funds during the highs and lows of the market without having to time the market to make your money investment. This is something known to everyone. You cannot time the market, but you can invest different time frame, and that's where the systematic investment plays an important role. Market time can be risky proposition, and one can invest at the wrong time. If somebody told me tomorrow that, hey, it's a good time to invest in the market because yesterday Nasdaq has fallen 5%, if you're aware about the market, I will say like, yeah, thank you, but it can fall down today or it can go up. So instead of doing a day trading, you will understand your assets, you understand your allocation, and remove the unpredictability from your view and thinking in the portfolio. So systematic investment plan works very well in this. You have a flexibility to the investment tenure. Tenure is a term which you choose if you like to invest. When I say tenure, remember one thing, tenure is not the advisors telling you. Tenure which you decide to cater your personal objective, which can be a short term to moderate term to the long term. A lot of things I've been seeing in the Singapore at least, that the clients have been advised to do a 60-year plan. My goodness, 60-year plan is, I don't know if an advisor going to be managing my portfolio or not. The tenure is very important, where you need your money to fund your personal objective and cater your personal needs. So make sure that you choose it correctly. And if you have any existing investment, please reevaluate that one actually. Frequency, I will always say monthly for a reason, because if you're investing into active fund management, active fund and daily traded, frequency monthly should be make more sense on that. And automate your investment, which means that you don't need to worry about your thinking about that how much you're going to invest every month. It's pretty much decided on the proper review with the clients, or proper review with your advisors and the clients understanding on that. This can be done through various ways. It can be disciplined by a banking standing instruction with gyro or credit card deduction. That can depends on the providers that you're dealing with right now. So that's pretty much relates with that providers, clients, and how they're gonna choose to pay this funds to us. So what is benefits of SIP? Compounded growth is a very important, strong fundamental in the investment strategy. Whatever I say is a more important dollar cost averaging. It's a very important aspect. It's a backbone of the portfolio in a monthly investment strategy, which I'll explain later. And people who understand dollar cost averaging is great, but which not, it tells you the valuation, that how the value can be in a tenure which you choose when the markets are volatile. Disciplined investment strategy. You don't need to have a decided every month how much you put. You need to have a proper strategy to allocate your disposable income, which comes to the fourth option. How much I should invest? The 30% of disposable income should be invested. What a disposable income means? If an individual is earning a month's expense is called disposable income. A partner earning the money minus expense is considered disposable income. So let's say disposable income is $100. They should be investing 30% of that, which is $30. Make sure this is not your commitment you're putting in. This is the asset which you're putting in an investment, and it shouldn't be sound like a liability to you. It's an asset which you're putting and growing a value. A right tenure should be chosen to cater your personal objective, as I said to you last slide. Tenure term is very important. Most of the time, the client has chosen 30 years of tenure, where the client required the money in 10 years. Sorry to say, you're going to have a massive impact on your investments. So make sure you should be aware when is the capital reliance period required, and accordingly, the tenure should be chosen. This is the prime objective, even you investing your penny into any of the market or the aspects of that. So please keep yourself, understand when you need the funds and how much you need to invest. You shouldn't be over invested, and you should not be a short investor in terms of the framework you do. Dollar cost averaging. So this is a very simple fundamental to explain to you. You can see the two graphs over there, Fund A and Fund B. As you say, the Fund A is very symmetric and moving into one line. So just to give a perspective, this can be a bond, or that can be a fixed income instrument. Unfortunately, this year, fixed income instruments were falling down. So that's it, one happens in 12 years. But in the fund B is very volatile, which changes every year, which can be in a form of US-China tariff, which can be in a form of COVID, which can be a form of right now, which is interests are going up, interests are going up. That can be a very basic. It fluctuates a lot. What it explains to you, systematic investment plan really helps you to build your wealth in a volatility perspective. So this gives you option. Consider the price movement on two equity funds, Fund A and Fund B. Fund A will be a golden color and Fund B will be a darker color. Fund A being a more stable fund means it fluctuates, but it doesn't fluctuate a lot. But Fund B is for a very volatile fund. I'm not saying about buying into cryptos. I'm saying about in the 3 years, it fluctuates and comes back to the portfolio, the NAV value. Fund being a more volatile fund. The chart shows a cumulative value of annual investment of USD 10,000 along with the unit price at a time of each of the annual investment were made. Lower unit price available under Fund B over the period means the investor benefits with the volatility more in Fund B. So if you see the chart, Fund A is 10,000 per annum for 10 years, is around 100,000, but total unit purchase is 7,161. If it's not fluctuated, it's a lump sum investment, the value will be 1,43228. Whereas in Fund B is 1,96454. It's a massive difference of close to 53K. Now you compound this thing in 10 years, 15 years, 20 years, depending on how the client going to achieve this objective in the term. So systematic investment plan is always helpful for volatile market. Systematic investment plan is very helpful at current scenario. So it depends on the client's objective. You should be planning the investment strategy accordingly on this. So what are the benefits with us? So when we advise our clients, we give a choice of plan currency. So you're earning in Singapore dollar. You can start investing in Singapore dollar, but it can even move to different countries. You can go to UK, you can go to Australia, you can go to States. Your earning incomes change. So you have a plan currency. You can start in Singapore dollar. You have option to convert your currency in the future. So it can be USD, SGD, sterling, euros, Hong Kong dollars. It can be AUD too. So depending on the client's objective, depending on the client's relocation, they can choose that. Tenure starts from 5 years minimum. So 5, 6, 7, 8, 9, 10, goes to 25. I'm not a big fan of 25 years. Traditionally, I've been seeing the client will be paying at least 13 to 14 years of a tenure, or they surrender that policy, or they take the investment out. What is the minimum amount we invest with us? $620 for 10 years and 125 for 5 years. These are numbers for a plan perspective, but as an individual, you should be investing 30% of your disposable income. How does you hold a plan? It can be individual, it can be corporate, it can be a trust. Anybody need to be 18 year old and more than that. And in a plan, you can have a 4 plans. So I'll give you an example. It can be a very basically an individual running the plan. Second category, plan with partners. Third plan can be partners plus their kids, so they can pass the policy in the future to the kids to invest on the money on this. So there can be a various way you can structure it right now in investment, depending on the client's objective on that. One of my clients came back and said, like, hey, I have a kid who's 21 years old, started earning money, and they want to put some money on that. So they started a plan at 21 years. So they can also build up the plan, can they add the ownership as a husband and even. So it's very much flexible in terms of the way you want to structure the plan on this. Flexibility. So when you start an investment structure plan, you can always do a lump sum top up. The minimum is 4,500 Singapore dollar in investment structure. Personally, I don't advise my clients to do a top ups on the single regular saving plans. They can always do in a lump sum side, which I can explain you to 2 buckets here. If you have a monthly investment, if you get promoted and if you have a more disposable income, you can always increase your monthly investment. The minimum increment is required 75 SGD. Switch currency, initial period. I don't want to confuse in the seminar. Initial period is a particular tenure. give into any plan before you switch the currency. Means you're putting in a Singapore dollar. If you move to the US, if you move to Australia, you can switch the currency too on that. Premium flexibility. So premium is considered as a monthly amount, by the way. Premium holiday, which is a cooling off period. If any unforeseen activity happen, you can take off. Cooling off period, which you don't need to pay premiums. Premium paid up. Premium paid up for a reason like, hey, listen, I have chosen 10 years. I paid for the 5 years. I don't want to pay anymore. You say like you just stay invested. You don't want to pay, you say paid up. So no commitments. The investment continues to 10 years and withdraw the money. Reduction, you can start with 2 grand, but in unforeseen activities, you cannot continue the premium. You can always go down to the minimum value. So a lot of things, a lot of premium reduction have happened to most of my, I won't say most of my clients, but 10 to 20% of clients during the pandemic time when there was a uncertainty was there. So they reduce the premium and they have increased the allocation last year. So it's all very much flexible in terms of the individual who want to build up the plan for a long term, especially for the expat who doesn't know how long they're going to stay in Singapore and how they're going to plan the investment. Change your beneficiary, it means like you can always transfer your investment to other names. So it can be a plan owner, but you can transfer to a third person, fourth person, depending on how you're going to do this. Important thing, when I invest into your funds, free multiple switching of funds, which means I can invest from equity to bond or vice versa. I can go to Indian market, to UK market, to the US market, tech to healthcare. I can do multiple transactions, no cost for that. And more importantly, there's a no entry cost of any fund. So in Singapore, typically you see there will be initial sales charge or entry cost up to 5%. We don't pay a single cost in our portfolio, which is very reasonable. Because of course we have a fee depending on a ticket size. It's not expensive. It's very minimal. That can be taken care by the proposal with the client, the transparency on top of the proposal. What is the additional benefit? As I said to you, premium, which we use, our all investment have a life insurance policy. Why life insurance policy? You're not buying any coverage from here. The life insurance policy can be added in a portfolio to give you taxes and benefit on a capital gain if you relocate to UK, India, Australia, various countries. There are no mortality charges applied. So it's not like an insurance plan which you buy from a local provider in Singapore. It's 100% investment plan where you put your X money as a disposable income and everything get invested into a mutual funds, which we advise our client. And 100% location means there is not a single entry cost taken on that or mortality charges taken on that. Portability. No matter where you're living in the world, the contribution can be maintained and proceeds can be withdrawn. Only one question is there, right? When you sign this plan, you have to be in Singapore. If you look at the countries, the contribution can be made from any part of the world. Now, just let me tell you one thing. We have a clients in our GFC who started our investment, and 70% of the clients are overseas right now. So they're still continuing on the investment side. Institutional access, FPI is one of our provider. There are other providers also. They're all the big institution. So when you open the account with this for this investment, they can give you access to institutional class fund, which is part of our allocation in our portfolio. And why I'm saying this to you, because this makes a big difference in the portfolio returns when I talked about 10 or 15 years, which I'm going to share with you on the fund performance in the next slide on that. So as an individual, it cannot access from the market. With our providers, with us, when you define our portfolio, when you define our objective of our clients, we do have a recipe of institutional class or retail class to buy the investment plan. Clustered plan. I don't want to make it very confusing, but every investment you do with us is clustered. So let's say if you have a portfolio of $100, there are different 100 clusters of mini clusters. Why I'm saying this to you? Because in Singapore, there's no tax on the capital paid. But if you go to UK, if you go to Australia, and if you go to India, taxes can change on the capital gain. There's a way, and there is always a benefit gifting the clusters to your individual or taking the money out while you're being in Singapore or when you've grown your money with a capital gain. This all can be taken, and I can address with you when you have a face-to-face, and most importantly, as expats, you don't live in different countries. So these investment plans are very much beneficial. Of course, you want to grow your money in a big term and a long term, but you also want to get some benefits from a capital gain tax. So we can always discuss this on an individual perspective and the objective, but there are examples of clients who have utilized these benefits when it comes to take their money out and we're not in Singapore or other countries of the world. It's a very vast topic. There has always been we have discussed this in the past seminars or webinars, which we have on GFC channel. So you can always log into GFC YouTube channel. I can look into this. Otherwise, any specific question, you can come back and we can discuss this one. Sample portfolios. These are portfolios that are running from a long time. I would say 7 years. The client's portfolio, which has invested around 2015. Since the 15, they invested in 2022 March. And there are different funds which have been invested on a regular basis, which is Fidelity America, Fidelity Global Technology, Fundsmith Equity, the institutional class fund, Invest for Healthcare. What they're showing it to you is I want to focus on average growth investment, which is considered annualized return on a portfolio. So Fidelity America has gone 30%, Technology has gone 107%, Fundsmith has gone 18.53%, Healthcare has gone 19.13%. So why I'm showing you a breakdown, if a client invests with us and invest for a long-term tenure, they should be knowing that how much they're making money and how they're making money and how the average growth may be on a portfolio, which is pretty much transparent to every individual in our GFC clients who can see this, I can understand, I can take a CAGR annualize it on that. This is a monthly return. So this client has invested since 2016 until 09/2022, which is this month. How the portfolio is done. You can see the one thing I want to see is a linear line with a different fluctuation. And what I'm saying to you, if you stay long invested, you see the COVID, you see the US China tariff war, and you see the current breakdown, you're still making money. So systematic investment plan is so solid in terms of building your wealth, which can sponsor for the various needs. The graph is just telling you the whole portfolio. By the way, this graph is not meant to just invest into S&P 500. This graph is with a diversified allocation of the portfolio in different sectors, in different geographical locations, and different fund managers. Tiffany, can you go back to the slide? Slide back. This is what I meant. Fidelity, Fundsmith, Invesco. These are 4 funds. We have more than close to 1,200 funds which go into this and invest into that from an institutional class and the retail class. So it's our team who works on that according to the client's objective and risk profile, align with them and grow the portfolio and cater their personal needs. Personally, our client who turned 55, sorry for that, and on 15 July. And she's been invested for 7 years. And when she took the money out, she had a significant value in terms of CPF, in terms of the cash investment. So what we do, you hire us to rebalance your portfolio to cater your personal needs. So of course, every individual is different and every individual has a different objective. We try to work with them actually. This I'm just referring to you are different funds which you're investing for our clients, which you can offer from an institutional class fund. So this I'm showing you last 10-year performance, where Polar Capital Tech has done 306.67. T. Rowe Price US large cap had done 25706. Vanguard US 500 stock, which is 3% S&P 500, 217.93. Asian Equity has done 182.11. China has done for 88.39. These are one total return. But these are the funds we've been using for our clients for a long time for different portfolios. What I'm trying to say, I'm not telling you, hey, I'm going to make you 3 zeros for the return. What I'm trying to tell you, try to choose a sensible funds who can return to your portfolio, who can generate absolute return for you for as a client perspective and their risk profile perspective. These are equity funds, by the way. don't see the bond funds doing the similar way. We have funds which perform and they have written portfolio quite well. We have more funds to do that, but these are direct funds, and most of the funds you cannot access for most of the portfolios. This is I'm showing you last 8 years. Why I'm showing you 8 years? Because I think there's a one fund was not added in the portfolio due to there's different subclasses on that. So there's a similar portfolio for 8 years: 225, 196, 143, 124, 60, 47, 34. Even I do allocation properly, I will be growing more than 80% of growth and CAGR basis. Not sorry, AGR as a total return perspective right now on that. So idea is keep buying those funds, matured assets, matured allocation, matured geographical location on that. This is my best slide. I always say 2-bucket investment strategy. I am doing this for my own basis, for my own personal financial planning. So what is 2-bucket investment strategy? If you're staying in Singapore, you know how much is the returns gives your bank. So my first question to my clients are, please save 6 months your expense. Don't touch that pot. Even they're earning 1% interest rate, keep it in a bank account. But the rest of the money should be invested. So there's the one bucket which you have saved enough, keeping your emergency fund, this money should be invested for a long-term basis or for a short-term basis, which can be used for the paying mortgages, buying property, passive income, more-term saving. Features, these are the investment plan with the liquidity, very low fees. A lot of my retiree people take the regular withdrawal on a monthly basis, quarterly basis, the passive income perspective to fulfill their needs. With a lump sum basis, keeping your emergency fund, growing your money, depending on risk profile, very flexible, but more importantly, to grow better than a bank return on this. While your regular saving bucket is, this bucket, you have grown that. In the span of 10 to 15 years, with all your commitments coming through, maybe kids' education, whatever you do, this bucket is going to go and fulfill the various needs. This is going to be depleting. But while doing a systematic investment plan, this bucket, the regular saving bucket will replace this bucket, or the first bucket, which is a lump sum bucket. The 2-bucket strategy is very work. So you already have our investment, invest through that, 6 months saving in a bank account. This money should be invested, 30% of disposable income, putting us something into pretty much into a bucket which goes wing. And when this bucket, lump sum bucket goes out, the regular saving bucket replaces that. If you work this way, I can guarantee you, if it's done properly in a structured way, you feel your investment structure is so properly done. Now, there's a market risk, which you cannot avoid that. But of course, there's a strategy behind that. Second thing, don't get overcommitted. And third and more important thing is try to manage the risk profile diversified in the both buckets. It doesn't need to be at the one time. So this is my conclusion. Everything is very straightforward. So general advantages, SIP helps to take the vote in the market, which is happening right now. If you have invested your money, you can see that how your advantage is gonna be. If you're a disciplined investor, your emotion doesn't come in a portfolio. Should I invest or should I not invest? It's a disciplined approach if you do that. Don't get overcommitted. 30% disposal income should be invested. Very simple. And tenure should be chosen catered to personal needs. If you want money, please don't block it for 30 years. If you want money in 10 years, please don't block for 25 years. If you want in 7 years, please don't block for 15 years. That should be pretty much clarified when you do this investment. As I explained to you, dollar cost averaging and compounded growth are the backbone of this investment strategy. This is I'm telling you because this is a general industry I have seen buying industry for 10 years. Sometimes they do commit too much. And suddenly, instead of considering an asset, it's considered as a liability to them. So please, as I said to you, any individuals should be understanding about the expense and understanding of disposable income and just invest on that. Okay, as I said to you, plan on a wrong tenure. So a lot of people end up seeing that they invested for a good amount of money, but they planned for so long, they went into this money, they could not take the money out. The surrender value or the value of the investment is higher, but you can get the value out. So you need to make sense. How do you actually plan your investment? Not diversified portfolio. I'll give you an example. One of my clients invested into one fund. How can you rely on that? Your fund, you have a risk on a concentration risk of the investment strategy of a one fund manager in terms of where they allocate. If a fund manager get bankrupt, how are we going to do that? So you have to have a diversified portfolio in terms of geographical location, in terms of fund manager, in terms of sectors, and more importantly, in terms of risk profile. Something paying the hefty fee on switching funds. You pay an entry cost and switching cost on a fund. So make sure that you check with your advisors or you have investment plan. And fewer options to invest into funds. Please, please don't think these are the only 20 funds we're going to invest in. You should have an option. If I want to invest into the US market, and if I want to invest in the healthcare market, I should have given an option of 20, 25 funds, at least with the great fund managers. If I want to invest in a multi-asset approach, I should have more than 10 to 15 funds on that. So make sure you should have a more bucket to choose when things are not working as an investment strategy. One thing I'm offering to my attendees today is like, if you have a SAP portfolio, not with us, and outside, if you want to review a portfolio, we'll do this complimentary basis. But make sure that you do this by yourself first. And if you're not understanding what you're doing, please come to us. We'll help you to understand, and we can help you do that. As I said to you, this whole idea of this webinar was to educate the people and to understand where they are in their investment strategy. And more importantly, the market situation given right now, you should leverage or you should not leverage depending where you are in the portfolio. We are welcome to have a discuss with me or Rohit to understand what we can do with it. Next slide or Q&A. Thank you. If you have any question and answer, you're happy to ask me. I hope I was clear. If you have any Q&A, I'm happy to answer that.
Hi, Deepak. We do have a few questions for you from our attendees. The first question is there any liquidity in the plan in systematic investment?
Well, it is. Yeah, so the first thing like systematic investment plan is always clustered, structured in such a way that you're not supposed to withdraw everything in the same day. It's not like you plan today, hey, I want to wrap it up and take money out. But what I'm saying to you right now, if somebody is planning for 10 or for 10 years or 8 years, 90% of validity is there. They're going to withdraw the funds in our unfortunate activities. So it's very highly flexible plan. It's not something like an insurance-based plan which you cannot withdraw for 100 years or 25 years of your life. It's very highly flexible.
Great, thank you. Another question we have, can I continue the plan if I move back to India?
I just said to you, yes, you can. I just let you know my slides that these plans are very flexible. I have around close to 20 or 50 clients who have moved to India. They're paying in the currency. I'm like, there's the FX conversion happens because they're earning in INR dollar. But it's a structure which we can do that for them. But what I'm saying to you right now, depending on the clients, again, how much their disposable income is, when they move to India, disposable income goes higher, but the FX come into your perspective. But there's a way to do this without hampering a lot of cost to you and them. So it's very highly flexible, either you go to any part of the country.
Perfect. Any more questions? Please feel free to drop your queries here. Or if not here, you're more than welcome to have a one-on-one chat with either of us. As Deepak has already mentioned that it is a long-term financial planning and everyone is different. Everyone has got different objectives. Everyone has different financial goals, different time scale. So it'll be really nice to have a one-on-one chat and we'll be more than happy to do that. You have our contact details. Tiffany, if you don't mind, can you just show the contact details? You can just reach out to either of us.
Can I just want to interfere right now? When I say the long-term investment strategy, please make sure what we made of our long-term investment strategy is not only 25 years. Our long-term investment strategy is 8 to 10 years, which makes sense for the capital community for that.
Perfect. So thanks a lot, Deepak. Thank you so much. It's always worth listening to you. And we have a short video from Deepak's clients that we would like to show it to you.
Deepak is part of our community now, so it's really word of mouth. He's so amazing at what he does.
For one-on-one, he really explained, what their company do.
He was able to tailor, his solutions or recommendations to what was in my interest.
I think his honesty and clarity. He came across as someone you can trust straight away. He knew what he was talking, and he knew in a span of one meeting what we wanted. So we just felt that we could trust him and rely on him.
What I liked about Deepak is he's very personal. We swap WhatsApp messages on a weekly basis. We'll meet up. Everything's done in an informal way, which is how I like to have and build up that client relationship.
Having someone that can explain clearly, give me confidence on the plan we wanted to do, and the way he was able to match our expectation and the product was something that make me choose Deepak.
So I think for me, what's important in a financial advisor or consultant is someone I can trust, and someone I can trust to give me advice that's suited for me and my needs, and not, come in from a direction of selling services or selling products that I'm not comfortable
We
with.
definitely had two plans, one short term, what we want to achieve, and one the longer term. I wanted to have some flexibility, which I think GFC has in today's approach. So I think that really helped very well.
You're part of a network. You can trust him because if you let one down, it's a domino effect, but it's the opposite. So he helps out everybody, and he's quite popular in our personal community as well.
That was great. Thanks, Tiffany, for sharing that. And thanks to all the attendees. Thank you so much for your time. I hope you had points to be taken home. But as said, please feel free to reach out to either of us, and we'll be more than happy to help you with your planning. There are no obligations to any of our meetings. So just if you want to have as much information, feel free to do that. Thank you so much. Thanks, Deepak. Thanks, Tiffany. And thanks
Thank
to
you
all
very
the
much.
attendees.
Have a great
Good night,
evening,
guys.
guys. Thank you very much. Cheers.
Thank
Bye.
you. Bye-bye.